Will oil prices reach $120 in Brent? It may be difficult, but let's analyze why it may happen. To start with, the current environment is of massive underinvestment in the oil and gas in the energy complex. The level of intervention from many developed economies, governments, is so aggressive that it has reduced dramatically the level of investment in exploration, production, and development in non-OPEC countries. Therefore, the growth in non-OPEC supply that used to mitigate and offset the production cuts from OPEC and OPEC Plus, including Russia, is obviously not going to work this time because the underinvestment in energy reaches more than $600 billion per annum. This means that the tightness of supply is something that is more of a challenge than ever. If investment is not reconducted and increased, there is obviously going to continue to be a tight level of supply relative to demand. Between May 22 and May 23, we saw a massive decline in oil prices and in all commodity prices. It was driven by central banks. Massive rate hikes. Monetary contraction means it is more expensive to store, to transport, and to take long positions in commodities. And that definitely reduced the prices of oil and of most commodities to below pre-Ukraine war levels. What has happened in May? Everything turned around. On the one hand, central banks started to stop rate hikes or to at least announce the end of rate hikes. Monetary contraction also stopped. We saw an improvement, an increase in global money supply. And furthermore, at the same time, the impact of production cuts from OPEC plus lower non-OPEC production creates a tighter supply environment. We also have the Chinese slowdown. The recovery in Chinese demand has been weaker than expected. However, it is stronger now and it's getting better in the next month and expected to continue to rise in terms of imports of energy. So, higher demand, or at least an improvement in demand, plus tightness in supply, lead to a more challenging environment in terms of prices. However, the monetary, let's say, loosening environment helps commodities rise faster as they are doing. So, tightness of supply, improvement of demand, loosening monetary policy, and a very important factor, which is that the Chinese slowdown doesn't last forever. So all of these factors, very relevant. On top of it all, a massive level of underinvestment that creates a constant tightness in supply. So Western governments have their own problem, which is to massively limit energy investment in an environment of challenging prices. So prices may rise back to May 22 levels, but then demand destruction will come in. Demand destruction kicks in very rapidly, and then it is very likely that even with some production cuts from OPEC, which has only reacted to lowering prices, OPEC has not driven oil prices higher. OPEC only reacts to lower oil prices. Therefore, with all of those challenges, geopolitical, supply, underinvestment, and monetary limits and problems, all of those factors may drive oil prices higher, but demand destruction kicks in faster than one would think. Let's look at that point and monitor the impact.